In the last two episodes, we spoke about the companies that I raised and lowered in my dividend growth portfolio here in my M1 Finance brokerage. And hopping into the dividend growth portfolio, you can see that we lowered two holdings, lowered one and raised one. The one that we lowered was Kimberly-Clark, down 2%. It was 5, now it's a 3% target weighting. And then we increased WP Carey 1% from 9 up to 10. And then there was one more that we increased, which is today's video, which is ticker symbol O, Realty Income Corporation, which was 8%, now targeted at 9%. Now this company has hit a bit of a dip here so far, down 13% year to date, down 8% in the last year. And this company pretty much has gone nowhere since about mid to early 2021. Now, I want to talk about in this video why I decided to increase it, talk about the company in general, some basic bullet points. So if you're not familiar with the company, or if you have heard of it and you don't know the basics to it, this is the video for you. Nothing too specific, just some of the basic bullet points and examples of how this company makes money, including this recent deal with Wynn Resorts. So if you haven't seen me before, my name is Jordan. I'm a millennial investor, and I like to show my portfolio balance at the first of the month every single month since showcasing my portfolio and starting this YouTube channel back in April of 2020. With my original investment of $1,500, we've continually put money in every single month, invested all of my very small YouTube earnings, which unfortunately isn't a lot, and then got to today's balance of just over $36,000, as you can see right here, 35. Now we also show my performance, and this is my performance over the last month, 3 months, year to date, and 1 year. And then we also have referral opportunities down below. So if you like this brokerage that we're showing right here with all these different holdings and how I share it to you down below in the description, you can get $10 for free by signing up, which 125 people have done so far. You'd help support me, you'd help support the channel, and without further ado, let's go ahead and jump into Realty Income. If we look at the annual charts here, on the top line and bottom line, you can see that this company has a knack for growing its business. In 1993, only had about $50 million in revenue. Today, in the last year, it has over $2 billion in revenue. So that's a pretty substantial uptick, about 40x revenue from 93 to 2021. Now, not only top line, but bottom line free cash flow has grown significantly as well. And you can see over the last decade or two, that has just pretty much been on an annual uptrend every single year, which is what you want to see as an investor, especially a dividend investor. Now, this is a unique company that is one of the only ones in the market that does not pay dividends annual. It doesn't pay dividends semi-annually or quarterly. It pays it every 30 days, every single quarter, and it raises that dividend consistently on a consistent basis, and you get checks for owning this company every single 30 days, which is awesome. Now, enough about this company's performance and growing, but what do they actually do? So they are a REIT, which is REIT, stands for Real Estate Investment Trust, and they own properties in the areas highlighted in yellow, which is mostly based around the United States, but they are also in other categories as well, in other areas. They're in all across 50 states, as well as countries like Spain and the UK. Now, they have many properties all across the US, all different sectors, which we're about to talk about, including 286 properties in my home state of Oklahoma. And I think their biggest state, if I remember correctly, is Texas, making up 10% of their properties. Over 1,450 properties in Texas alone, my neighboring state. That's crazy. Now, if you want to see a quick snapshot, I won't go over all these. If you just want to pause it, they basically have 1,125 clients across 72 industries in all 50 states. And this is the type of snapshot that gives you an overview of what the company actually does. So if you want to pause the video, take a look at that. Now, the top 20 clients. This is an example of the type of clients that they have. So if you don't know the type of properties that they're leasing to, are they leasing to consumer-facing, non-consumer-facing companies? Well, this gives you an idea. Their top 20, in order from largest to smallest, is Walgreens, Dollar General, 7-Eleven, Dollar Tree and Family Dollar. Dollar Tree actually owns Family Dollar, so they're the same company. And FedEx, LA Fitness, Sainsbury's, BJ's, B&Q, CVS, Walmart and Sam's Club, which Walmart obviously owns Sam's Club, AMC Theaters, Red Lobster, Regal, Tractor Supply Company, Tesco, Lifetime Fitness, The Home Depot, Kroger, Fastmart, and so many others. That is just their top 20. Now notice with all of these, if one of them goes down, like an example as you can see from AMC, during 2020 when the pandemic happened, revenue and profitability just tanked and fell through the floor for a company like AMC. Now the cool part is a company like that only makes up 1.6% of Realty Income's revenue. So if this company's not able to pay its rent, which it is now today, but if it's not able to pay its rent, all these other businesses make up for. And these are in all different categories. It's not just one company. It's not just one type of company. Every single one of these clients are profitable and growing, and more importantly, provide profits and revenue to Realty Income, the real estate owner that they sell to. Now, not only do these 20 different clients have a lot of properties that they lease out of Realty Income, as well as all their other clients, their other like 1,200 or whatever clients it is, but you see that the portfolio that they have of properties is constantly leased out. I'm going to drag my mouse here from the start of 1992 all the way to the most recent year-to-date of Q2 of 2022, and you can see that generally speaking, across the board, it doesn't matter what year you look at, generally speaking, around 97 to 99% of these properties are leased out at all time, bringing in money. There's always about 1 to 2% that is in the process of finding a new tenant, or maybe it's down for some sort of construction repairs, but whatever, you get the point. 98, 99% of the time, all of these properties are either rented out or very close to it, which has an incredible profitability return for shareholders when they're constantly bringing in cash flow. Now, not only do they have diversified clients, not only are they spread out geographically across the 50 states as well as some other countries overseas as well, but not only that, they have a track record of growing positive earnings 25 of the last 26 years, with an AFFO, which is adjusted funds from operations, which is kind of like the profitability for a real estate investment trust like Realty Income, has grown at a compounded rate of 5.1%. The dividend has also grown 4.1% since 1994, and the company's total return in the stock market has produced a 15.1% return since 1994, which is absolutely incredible, while having half the beta of the S&P 500. You do not see this type of return with this type of beta very often. It is very rare to see that. So hopefully they can keep that moving forward in the future. Now, you might be looking at this and you might be saying, okay, Jordan, I get the point. I get that they're a real estate company. I get they own properties in the U.S. and overseas, and they have a lot of clients. They're diversified. They have profitability. But what's an exact example of this? Like, I know that they sell to Walgreens and to Dollar General and to Home Depot, but what is an exact example of this? Well, let's show the recent deal that they did with Wynn Resorts, which was a pretty big deal, especially for a company this size, which was $1.7 billion to Wynn Resorts. They purchased the Encore Boston Harbor Resort and Casino for $1.7 billion at a 5.9% cash rate. Now, if you don't know what that is, a cash cap rate is the return on investment that a real estate company gets, right? So if you get, say, $100 and you invest it into real estate and you have a 6% cap rate, then you're going to get $6 of rent every single year. If it was a 7% cap rate, you would get $7 of rent every year. The same thing here, but it's with bigger numbers, $1.7 billion to be exact. So they're going to get back 6% of their money every single year just to hold this. Not only are they going to get 6%, but one, the company is going to continue to raise rates, which we'll talk about in a second, and two, the property values will eventually go up. So let's say that the property values for these beautiful, unique, compelling properties that are only specific to the Las Vegas area. You can't really replicate the Encore in Las Vegas. It is massive. Now, if this property were to grow at an annual rate of, say, 2%, which is pretty conservative, the property value going up 2% every year, which is not some crazy unrealistic number, then they're making 8% on this. They're making about 6% on the cap rate, and then 2% on the property growth, and then more importantly, this last sentence, the transaction is consummated under a 30-year triple net lease with favorable annual escalators, which means every year they will increase the rent on Wynn Resorts. It's already written in contract for the next 3 decades. Hey, if you're paying us $100 million this year, you're going to pay us $102 million next year. The year after that, you're going to pay us $105 million, $106 million, whatever the number is. That is already factored into the contract. And that's what leads companies like this to increase its revenue over time from not only new properties that it buys, but its old existing properties with high cap rates and rent escalations. And not only that, but that's what leads this company to continually raise its guidance, just like it did this quarter, with its net income per share being at a midpoint of about $1.15 or so, now being raised up to about $1.20. Now, this company has a risk that a lot of people are worried about, which is lowering real estate values and rising interest rates. Now, I want to talk about what this company looks like financing properties right now and what it might look like in the future. You can see that their interest rates on these are very attractive. I think there's only one here that's in the 5, so I can find it. Yeah, right here. Due 2035, they have a 5.8% note. Every single one of these, other than that one, are 4% or lower. Some of these, including like ones like this one, are below 1%. They have a 0.75% interest rate on this note. And like this one, they have a 1.13%. So when they finance this deal, when they raise $325,000, it doesn't matter if they get a huge return. If they can get anything over 0.75%, then they're making a profit. And that's obviously ridiculously low, but many of these, even in the 3 and 4% range, are still very easy to beat when you're getting cap rates like this one of 5.9%, plus increasing property values, plus rising payments over time as the rents go up. So this is just a beautiful business. It's one that's very lean. It doesn't take a lot of employees to run. And this is one that I like because a couple reasons. One, they're very defensive. Two, they have rising dividends. Three, those dividends are paid monthly. Four, this dividend yield is very high. Five, the valuation is very low. And then six, it's just a business that I like. I don't like buying properties myself. I'm not a huge fan of buying real estate individually. Now, there's nothing against people that do that. There's many who are successful at it, but the only real estate I own is my home, which I'm brand new homeowner. I hadn't even owned my home that I'm sitting in right now 2 months, so I'm brand new to this. But this company, in my opinion, has lots of opportunity. And if we look at the two portfolios that I have in M1 Finance that I shared down below in the description, we have the growth portfolio, which is very concentrated and very aggressive and focused on growing capital, and usually is very volatile. Sometimes it's very good, sometimes it's very bad, like it has been so far in 2020. And then the dividend growth portfolio is one that is supposed to be defensive. If you look in the last year, it's only down 7% when the market is down like 20% on average plus. I think actually over 20% in the last year. And considering that this basket of companies only down 7% is very good, and it's because of owning companies like this, like Realty Income, that can hold up despite economic booms, economic busts, recession, rising interest rates, lowering interest rates. And another thing I want to mention here before we close out is that I know people are worried about rising interest rates for real estate companies like this one. And it's true. It will be harder for them to finance attractive deals, but eventually interest rates will go down. It might be next month, it might be next year, it might be 20 years from now. But at some point when interest rates go down, they tend to refinance all their debt at lower rates, just like they did here, which is why you see every single one of these at extremely low rates. And that gives a company like this, a triple net lease real estate investment trust, opportunity to grow profits and revenue for investors. Thank you guys so much for watching. Check out all the stuff down below in the description if you haven't already. Sign up with M1 Finance, which is a $10 referral, which would help support me and the channel. But without further ado, my name is Jordan. I'm a millennial investor, and I'll catch you guys next time.